Guys, 5 stocks that tech investors are buying right now. The last one may surprise you, so stick around. Number 5, CrowdStrike. Let's pull it up right now. It is an interesting company for one major reason. Mo, this is what jumped out at me about CrowdStrike. Look at their free cash flow. Last 12 months, $864 million. Wow. Last 5 years, average, $415 million. But look at their net income.
Losses.
So it's a lot like other tech companies out there that are starting up. I don't know if it has something to do with their depreciating and expensing their costs because of accounting rules, but I would focus here on the free cash flow. Obviously, their profit margin is negative because of net income. And you might wonder out there, how can free cash flow and net income be different? They can be different based on accounting rules. Free cash flow is cash from operations less your capital expenditures, but net income has so many rules attached to it from the SEC, from accounting, from GAAP, and blah, 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 blah. So, Mo, you have a market cap very close to your enterprise value, which means very little debt. I mean, this is not going to be a pretty company when it comes to the 8 pillars.
No. This is not one of those that you're going through a screener and saying, oh, this looks pretty good.
No,
you got to figure stuff out.
And look at this. Shares outstanding up 17.25% in the last 5 years. They are diluting their investors, which means, guys, they basically told the investors the last 5 years, hey, thanks for sticking with us, but we're going to add more investors here and take some of your profit away and give it to them.
And they are still adding substantial amounts of shares every quarter.
But look at this, Mo. This is why it's exciting for people. 52-week low, May 3rd of $115, and it's currently at $325, almost triple the price from less than 1 year ago. The tech market is booming right now. All right, so analyst estimates. Let's see what the analysts are saying about CrowdStrike. Oh, wow.
It's a lot.
They're expecting, how are they expecting $4.81 earnings per share, even though they lost money? This is interesting. Growing to $12 a share. So even at $12 a share in 2029, the stock price is currently $325 divided by 12, 25, 27 times 2029's earnings. 27 times. It's hard enough to pay 27 times next year's earnings.
Right.
This is 5 years from now. I mean, revenue is growing substantially from $3 billion estimated to 10.54. So it has a very sexy appeal to it. Grow. The question is it worth it? So let's do our stack analyzer tool. Mo, I don't think I've ever done this one. Have you?
Yeah, I'm going to look in my history. Have not. Okay.
All right, so let's make some assumptions over the next 10 years. Mo, give me your revenue growth assumptions for this company.
15, 20, and 25.
Okay, sounds good to me. And guys, I want everybody to remember, go look at the history of how many companies have grown 20% a year in revenue for 10 years.
Right.
It's difficult.
Right.
Not saying it's not going to happen. It is very, very difficult. So we're trying to be optimistic here.
What do you want to put in for profit margin?
I don't know, because look at the free cash flow.
I know. I was thinking, do we just match it to free cash flow?
I think so.
Okay.
And the reason being, eventually over time, they'll equate. And guys, I want to repeat, I'm glad that free cash flow is greater than profit margin. If this were flipped right here, I'd probably immediately say, I don't want to look at it any further.
And I also want to say, the profit margin we're going to put in here and the numbers that are going to come out on the other side, that's assuming profit today.
Correct.
So,
and I'm okay with that because of cash flow being there
exactly.
today.
Yeah.
So Mo, give me your numbers.
Why don't we go 25, 30, and 35?
I love it, Mo. You're a man after my own heart. PE. That's the hard one.
This is hard.
Because the price to free cash flow is 118 currently. So the question is, what's the PE going to be 10 years from now?
18, 21, and 24.
Sounds good to me. And for those of you who think we're being too conservative, that's why we have this tool out there. You can do it yourself and put whatever numbers you want in there. Now, Mo, are we going to do our own desired return, or are we going to do the market 9% and then tell everybody? I think we should do the 9% across the board. So guys, what we're doing here is, this is basically where you put your margin of safety in. The higher your desired return, the more margin of safety. We're trying to assume the market return of 9 or 10% here, but so that whatever numbers pop up will not include any margin of safety. Hit the analyze button. So guys, it's still looking expensive even today. We have a low price of 125, high price of 463, and middle price of 245. So for me, it's just a pass for me. Would you say, Mo?
Yeah, I would pass on this. There's better companies out there.
I agree. Stock number 2, AMD. Guys, this one's riding high because of the whole AI boom. Am I wrong? I mean, the whole chips with Nvidia, it is riding that coattail. I mean, look at this 1 year return, 125% over the last 1 year.
The 52-week low was March 2nd of 2023 of $76.65. Today, we're sitting at $177.
I mean, it's nuts. $287 billion market cap, $293 billion enterprise value, little debt in there. 5-year profit margin. Isn't this interesting, though? This boom, Mo. And look at their profit margin.
It's very low.
3.8, which is lower than their 5-year average.
Yeah.
Now, their free cash flow. Okay, I like this.
Yep, that's
free
higher.
cash flow is both in 1 year and the 5-year are higher than the net income numbers. All right, so it makes me feel better about the numbers. 5-year return on invested capital is decent, 11.6%. Good, and I'm glad they don't pay dividends. I'm surprised by that because everybody wants to pay dividends these days. Man, look at this company. Here's the interesting part about this company. You ready? The 10-year return is 4,700%. The total return since the company went public, 1,000%. So even if you bought the company, I mean, you have to, if you bought it day one in the IPO, you would have seen a massive fall to the point of 10 years ago where it then just skyrocketed from there.
Right.
4,700%. All right, let's look at those 8 pillars.
Look at this.
42% shares outstanding.
Oh, come on.
You know what they did right here, guys? They said, hey, investors, we love you so much. Go F yourselves. That's what they did right here. They totally F the investors. I get it. Their stock, this is their way of saying we are massively overpriced. This is the company's way of saying we are overpriced. Because if they weren't saying that, if they were saying we were cheap, they'd be buying back shares.
Right.
I'd probably disagree with them anyhow. But the point is, this is their way of saying if a company's board thinks they're so expensive that they're issuing a lot of shares, that should be your indication that you should be careful. And in the last 5 years, they've been like, oh, these prices keep going up. Let's just keep issuing shares.
Going, yeah.
Let's get that cash in our pocket. Mo, what are analysts saying?
Let's see here. Okay, going for end of this year, $3.86 a share to $8.50 end of 2027. That is some big growth. And on the revenue side, $27.1 billion to $42.23 billion. That's big too.
So yeah, but it's not like it's 30% growth levels.
It's a shade under 20.
All right, so overall, guys, looking at 15 or 16% annualized revenue growth for the next 3 years. So here's my stock analyzer tool I did back in January 30th of this year. I did 8, 12, and 16%. Now, you might sit there and say, Paul, you just said 15. But this is over a 10-year period. That was 3 years, okay? So I'm fine with this aggressive 8, 12, 16. Profit margin, I did 8, 15, 22. And I did the same thing for free cash flow because they are pretty similar here. Okay? Now, I'm glad that free cash flow is higher, but I still kept it the same. PE. Let's just do this 18, 21,
just keep it at that.
And 24, just to show how crazy this is.
Yeah.
I hit the analyze button, 177 per share today.
Oh my.
I have a low price of 28, high price of 175, middle price of 80. Again, assuming no margin of safety. I did the 9% return. Guys, if the middle assumptions occur and you bought today, it's a negative return based on discounted cash flow.
10% revenue growth is really good over a 10-year period.
Yeah, it is really good. That's exactly it.
Yeah, that's the crazy part.
All right, stock number 3, an everything money favorite, Palantir. Palantir's crushed it this year. They got as low as $5 a share, somewhere in the 5 range in the last 2 years, and have skyrocketed since then. They've been recording good free cash flow with growth, which is much higher than their net income in 5-year. Our issue with Palantir, in full disclosure, we don't like how these numbers have been just coming right in.
Right in.
Oh, just perfect.
Yep.
And it's funny to me because they have the cash flow, Mo, but they're pandering to investors, and they'll pop up a little small asset here that just did really well and got them to beat by 1 penny or got them to match exactly on the nose.
Quarter after quarter.
Quarter after quarter. The funny part is they're not focusing on the one thing. So to me, it says they're not looking to show, they want to please the markets and not make the business better. Guys, you have to remember, if you run a company, how do you make the investors happy? You run a really good company. You increase revenue, you increase profit, increase free cash flow, pay down debt, or keep debt manageable. That's how you make investors happy. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. The fundamentals of the business will get, as they get better, will drive the stock price higher. Yeah. So when they're playing these little games here,
it's a short-term outlook.
It's a short-term, makes you wonder, are there options they're going to get That's a question you have to ask. And guys, keep in mind, this was founded by a guy that I respect a lot, Peter Thiel. Okay, so I don't know. Now, here's a good thing about Palantir, $57 billion market cap, $54 billion enterprise value. They have more cash on hand.
You're not going to like their shares outstanding when you look at the 8 pillars.
Oh, boy.
Oh, boy is right.
Welcome to your world of go F yourself, investor. I don't know. Even when I was interested in it under $5 a share, it was still a doozy for me to say, what do I really want here? What are analysts projecting here?
30 cents in end of this year, going to 83 cents end of 2028.
So it's not like it's an insane...
No, it's not.
It's not like they're growing at an insane amount.
And if you go to the revenue side, 2.71 billion going to 6.5 billion at the end of 2028.
All right.
So
guys, it's growing, but look at that profit. The profit's not, I mean, it's not like it's going from 30 cents to $5. It's going from 30 cents to 83 cents over a 4-year period, 5-year period. Now, guys, we did the stock analyzer a little bit ago. I did 8, 16, and 24% revenue growth over 10 years. I did 15, 25, and 35 on the profit margin. I did 20, 30, and 40 on the free cash flow. I just assumed their free cash would be higher. Probably shouldn't, but because over time it'll even out. I did 15, 20, and 25 in the PE and a 9% return. Guys, I mean, can it work? This is no margin of safety here. Low price of $3 or $4, high price of 35 to 40, middle price of 11 to 15.
No margin of safety, and they're going to probably keep diluting you.
That's a concern, is the dilution.
Yeah.
The concern is the dilution. Stock number 4, Salesforce. Guys, Salesforce is a company that we use in our office. They have great software. They own Slack now, which I'm sure a lot of people who work in a company understand Slack. Look at every single tech company in the world looks like this right now. This is the chart. This is the chart for every tech company. Guys, stocks only go up, right?
Yep.
Free cash flow. Look at this, Mo.
Significantly higher.
Free cash flow in the last year of $8.8 billion versus $2.6 billion in net income. 5-year average free cash flow of $5.4 billion versus $1.8. Focus on that free cash flow, baby.
Love it.
Enterprise value, yeah, pretty reasonable. 315 versus 295.
Not a lot of debt.
Not a lot of debt. Profit margin, oh my God, gross margin of 75%, profit margin of 7%. This is a really high gross margin, guys.
Yes,
This is higher than Microsoft. This is higher than Oracle. That's pretty solid. Low return on invested capital. They're growing a lot. They're probably, let's see, their shares outstanding. They're probably diluting people.
That bad.
Not that bad.
Not that bad.
10.6%.
Yeah.
But look at this 5-year PE, 165. 5-year price of free cash flow, 55.
Yeah.
I like the fact this is lower than the PE, but it's still a lot.
Yeah.
Analyst estimates.
$8.28 by the end of March of this year, going to $15.55 January of 2029. So about double.
Okay.
Revenue, $35 billion to $61 billion, end of 29.
So low double digits, but that's pretty good growth, guys.
That's good.
So this is what I did in my stock analyzer tool. 10-year analysis, 7, 10, and 13% revenue growth, 7, 12, and 17 profit margin, 17, 19, and 21 in free cash flow. Because look how much their free cash flow crushes their profit margin. And for me, at the end of the day, what matters to me is free cash flow. I'm going to focus more on that number. PE, price of free cash flow. I did 14, 17, and 20. I could probably justify going higher because they are the gold standard.
Yeah.
I'm going to go 17, 20, and 23.
Okay.
Because they are the gold standard for, I think, for CRM software out there. Hit the analyze button. The stock's currently at 300. I have a low price of 131, focusing on discounted cash flow. High price of 320. Middle price of 206. So without margin of safety, I think I like my 150 price.
Yep.
My current watch list price. Now, guys, you've seen this software. We use it a lot. We talk a lot about our community of 1,000 investors. Over 16,000 people since we started the software have signed up. There are thousands of active investors. Guys, here's what our software can do for you. This software here is incredible. You get the mobile app, everything you've seen here on your mobile phone. You get the 8 pillars, over 30 years of financial data and adding more every single year. Our stock analyzer tool, exclusive content from Mo and I, access to Mo and I. People message us all the time and we respond to people in our community. News, 8-pillar portfolio where you can look at all your stocks as a whole and say, how do they look as one company? Retirement calculator, which I even use every single week. And most important part, EM community of like-minded investors. Guys, investing's tough. It's a lonely road. This community was built to have everybody sit here and talk to each other. There are a lot of different ideas out there, and this is all available. We have it written here at $49, but right now we have $7 for 7 days at everythingmoney.com. Go sign up. You get all of these green check marks here versus our competitors who are much more expensive and don't provide as much. So $7, 7 days, everythingmoney.com. The final stock, the big surprise. I'm just kidding. It was no surprise. It's Nvidia. We all knew that going into this. It's always Nvidia. I was just out of town this weekend at a friend's house, and everybody's talking about Nvidia, how incredible it is. The funny part is the one person talking about it and how he had it, he didn't even know what they did. And I sarcastically said, so you own a company, you don't know what they did? And he goes, well, I'm not the one that bought it. My money managers did. And then he looked up what they did, and I was correcting some things. I'm like, well, that's not true. And then he's like, oh, okay. So anyhow, that's the hype around Nvidia.
I got a good story, too. There's a kid, he was 15 years old, and he was playing in like his Robinhood account. He bought it like 10 years ago, and today it's doing what it does. He's like, I still own this company. I don't know what they do, but it's just giving me crazy returns. Like,
where was this from?
Awesome. Group chat.
Oh, really?
Yeah, one of the guys.
Wow.
Yep.
In 10 years, you've made 17,000% of your money.
That's it. And he still has no idea what they do.
17,000% in 10 years. That beats Buffett.
That does.
Thank you for laughing. This is almost a $2 trillion company. Oh my God, it's actually down today. How is that even possible? All-time high of $823.94 just a few days ago. Guys, this company is incredible. I mean, look at this 5-year profit margin of 38%, 1 year of 49%, gross margin of 73%. They're killing it. I mean, they're absolutely killing it.
The revenue growth quarter after quarter is mind-boggling.
Look at this. They actually pay a dividend, but it's so small, they actually it shows us 0% on our software.
Yeah.
Look at this return on invested capital.
It's impressive, almost 46%.
How much is this company up
over
in the last
12
year?
Months.
235% in the last 1 year. 8 pillars. Wow, shares outstanding is only up 1%.
Yeah, I'm surprised by that.
Guys, look at this. Look at this PE. 5-year PE of 187. 5-year price of free cash flow of 205. The current PE is 66. The current price of free cash flow is 73. Let's see what analyst estimates are for this company. What do they show, Mo?
$12.55 March of 2024, going to basically $35 at the end of 29. And on the revenue side, $60.25 billion end of March 24, $159 billion end of 2029. January 29.
Which is almost 2.5 times in 5 years. So guys, on our stock analyzer tool here,
this is going to be interesting.
I put 10, 20, and 30%. So again, 20% a year for 10 years for a company that's a $2 trillion company. I'm going to go ahead and say this, and I've said this in a couple other NVIDIA videos. I think we're going to wake up 10 years from now, and NVIDIA stock price is going to be lower. Market cap is going to be lower in 10 years than it is today.
It's going to be the Intel, Cisco.
I think so. These things don't fly high like this forever. And the parabolic rise will have a parabolic fall.
Funny part will be they'll be a better company at, what'd you say, 10 to 20 years from now than they are today.
They'll be a better company.
They'll be a better company doing great revenue.
They'll have better revenue, better profit,
exactly.
everything. And people are going to say, this company sucks. You know why? They're going to follow the stock price.
Yep.
Okay, I did 20, 30, and 40% profit margins. Same with free cash flow. Okay. I have to assume as competition increases, margins will go back to normal levels. PE, I did 20, 25, and 30. Guys, I think this is an absurd PE. I'm putting it in there.
Yeah.
Just to keep up with the market. 9% return. Analyze button. Remember, guys, $7 for 7 days, everythingmoney.com. Hey, on the high side, 30% revenue growth a year makes sense. Low side's 180, high side is 2,300, middle part 700, and again, it assumes no margin of safety. Thank you very much for your time.